Hello, a happy Monday to you. I'm Noel Lim on ASEAN Speaks by Maybank IBG. Investors are carefully watching developments as the US Federal Reserve shifts to a more hawkish stance in response to better economic numbers and rising inflation. Meanwhile, in ASEAN, to help you filter the noise and get started for the week, our analysts take you through their expectations for the Singapore budget, as well as updates from the property sectors in Thailand, the Philippines and Malaysia, and also the outlook for crude palm oil or CPO prices and output. Suhaimi Ilias, our Group Chief Economist, moderates today's Monday briefing.
Good morning, everyone. It's Monday, 17 January 2022. As usual, we start with a recap of the week that was. Concerns about persistent inflation and more aggressive monetary policy tightening loom large over market sentiment and movement last week. This is especially with US inflation rate in December hitting 7%. That's the highest since June 1982. And core inflation rose to 5.5%, the most since February 1991. At the same time last week, we saw hawkish statements by US Fed Chair Powell and other senior officials, leading to speculation of more aggressive monetary policy normalization and tightening in US that included as many as potentially 4 rate hikes this year, starting March, as well as quantitative tightening later this year after the expected completion of QE taper by March. And amid the worry of stagflation, US yield curve flattened last week as US Treasury yields on 2-year increase and the yield on 10-year drop. And underscoring inflation race, closer to home, Bank of Korea raised interest rates by 25 basis points, I think for the second month in a row, to 1.25%, i.e. bringing back benchmark interest rate in Korea to a pre-pandemic level. And the central bank there signaled more rate hikes potentially coming. On COVID-19, the Omicron variant has basically displaced Delta in the US, now accounting for some 98% of all cases. And amid the global surge in Omicron waves, China suspended dozens of international flights and issued more restrictions. Hong Kong reimposed some of social and travel restrictions. Germany plans to further restrict access to bars and restaurants. Japan extends entry ban on non-resident foreigners that has been in place since end of November last year until end of February. But some countries actually eased earlier imposed restrictions. So Netherlands, for example, relaxed its nationwide lockdown from Saturday, where non-essential stores, hairdressers, gyms would be able to open, albeit with a cap on customer numbers. France eased restrictions on travelers coming from the UK. Spain is changing its strategy from quarantines and restrictions to a monitoring system. And there are countries adopting stricter vaccination rules. For example, anyone 50 years or above in Italy and 60 years or older in Greece will be fined if they are unvaccinated. Meanwhile, UK cut the quarantine or self-isolation period for those who tested positive for COVID-19 as infection rates fall in London. I think the same was actually seen in some of the country in terms of reducing the sort of quarantine period for those tested positive, such as in Switzerland, Norway, and including Malaysia, suggesting a belief that the coronavirus is becoming endemic. Meanwhile, in China, I think the equity market over there was weighed by headlines about refinancing difficulties in the country's troubled property sectors. China's banks have grown more selective about funding real estate projects by local government financing vehicles. Some developers like Evergrande and Shimao are scrambling to obtain creditors' consent for maturity extensions and exchange offers. Other developers have intensified fundraising campaigns as traditional financing routes like pre-sales have dried up. A severe and prolonged downturn in China's real estate sector would have significant economy-wide impact. The World Bank warned in its Global Economic Prospect report, and the adverse impact of property sector weakness on China perhaps is showing as consumer and producer price inflation slowed more than expected in December. And today, with the release of a series of China's quarterly economic data, China's real GDP growth is expected to slow further to 3.6% year-on-year last quarter versus 4.9% year-on-year in third quarter 2021. Meanwhile, our in-house monthly GDP growth tracker for Malaysia indicated the economy expanded 5.6% year-on-year in November after the 2.8% year-on-year rebound in October that reversed the contractions in June, September last year. Economy grew 4.2% in October, November against 4.5% year-on-year decline in third quarter. Bank Negara Monetary Policy Committee will meet on 19-20th January this week. We expect no change in OPR, currently at record low 1.75%, but I think eyes will be on Bank Negara's monetary policy statement to see whether a neutral tone remains or if there's any hawkish pivot. Just to recap, our OPR view for this year is BNM will be patient on monetary policy normalization and focus will be on keeping monetary policy accommodative to support economic recovery process before a single 25 basis point hike at BNM's last MPC meeting for the year on 2nd, 3rd November. For today, we have Bin to talk about the upcoming Singapore's budget for financial year 2022, Thilan on Singapore's equity market outlook for this year. We have Vanida, Miguel and Wei Sam to share their views on Thailand, Philippines and Malaysia's property sector. Jesada will touch on Thai banks and Ting will come on there to give some plantation sector update. Let's start with Bin. Bin, Singapore's budget for this year will be out on 18 February. I think aside from the normal question about what will happen to budget balance, what will be the budget policy thrust and strategies, and what are the expectations and implications on tax measures and allocations for expenditures?
Hey, hi, morning, Suhaimi. So I think we think the theme for this year's budget is really about shoring up finances, in particular to finance some of the sort of big infrastructure projects and healthcare. So the budget will be unveiled on 18 Feb. That's about a month away. And I guess the watch really for about the new taxes. There will be probably a GST hike. There will be higher carbon taxes. And I think the government has also hinted of wealth taxes. So new taxes will throw sand on this uneven recovery path, but growth should continue to broaden, we think, with the reopening of borders. Still, we're looking for growth to moderate to 3.8% this year. Now, of course, I think our worry is that inflation is going to be the big challenge. A GST hike could increase the headline inflation by about 1.3 percentage points. And I think, therefore, there's a good chance that MAS will tighten again in April and possibly even more aggressively than we thought. Possibly there are both a steeper appreciation slope, but also a recentering of the band. I guess the good news is that the budget is turning out to be much better than expected. We're looking at a fiscal deficit of last year's budget to only be 0.1% rather than the projected 2.2%. So both the revenue line is coming in much better and the spending is also much lower. The operating revenue actually rose 42% in the first 8 months of the fiscal year. Corporate income tax went up 53%. Personal income tax went up 13%. Stamp duty went up 135% in the first 8 months. So that's pretty stunning. For me, it was the personal income tax that kind of surprised because, after all, there were an exodus of like 200 over 1,000 foreigners, from the labor force. I think that just reflects how uneven this recovery is. The higher wage sectors are still doing pretty well, and the resident participation of the labor force for the locals actually gone up. And spending is only rising about 8.4%, a bit below their budget. Spending is aligned for environment and water, transport and health, but fallen short for education, government administration, and culture. So what will the government be spending? What other taxes? We're looking for besides the GST, the carbon tax to be hiked. Currently it's $5 per ton, scheduled to go up next year. But I think faster than the previous timetable of $10 to $15. We expect it to go up to $15 to $25. Wealth taxes, what could they be? Minister Lawrence Wong already came out to say that there won't be a wealth tax on net wealth. So I think that's good news for the private banking industry. But on top of the property measures as recently announced, we think that they could still target the annual property tax which is quite low for especially owner-occupied. So that could be higher and that could be made more progressive. And that you could design it so that it's equivalent to a GCB tax. So property taxes may also be differentiated, we think, for citizens, PRs, and foreigners. That's one of the few things that has not been differentiated. Luxury cars, I think a tax is, the signs are there as well, so that could be road tax, excise duty, or especially on the more expensive cars. On the longer term priorities, I think the government will shift now to healthcare and infrastructure to tackle climate risks and increase renewable energy. There may be discussions on the minimum global tax, which, according to some of the global, the folks, they are planning to start implementation next year. We don't think they will impact Singapore's fiscal revenue that significantly because there are quite big carve-out sectors. So, financial is carved out, shipping is carved out, commodities is also carved out, which, some of this is important for Singapore. And we also estimated that the US MNCs are only paying 4% effective tax rate currently. So, it's so low that, raising it closer to 15% means that there will be some offsetting tax revenue. The job support scheme will probably wound down quite a bit. And I think there will only be like a 10% wage support for aviation and hospitality. The government has already set aside $6 billion assurance package to help cushion the GST impact. I think that could be raised to 7 to 8 billion, just to soften the ground sort of a criticism. We're also looking out for the infrastructure bonds. They have issued 2.6 billion worth of 30-year bonds. Just to recall that the government allowed for 90 billion of infrastructure bonds to be issued over the next 15 years, which actually relaxes the fiscal constraint, of having this balanced budget for the electoral term. So there could be more of this coming.
Right. Thanks, Abin. Maybe I'll bring in Thilan to talk about Singapore equity market outlook for this year. I think aside from kind of recycling question that I asked Maria and Tan's last week on Thailand and Singapore market outlook, Thailand and Vietnam's market outlook this year in terms of what are the investment cases and how should investors allocate their capitals in terms of sector weightings and stock picks. Maybe I'll kind of slot in also question about, what are your quick thoughts about the budget impact on market. Thilan.
Yeah, morning, Suhaimi. So let me just, I think the budget, as has been mentioned, is all about kind of trying to gain back revenue and things like that. I don't think it's going to have a major impact on the market, except for where the tightening is in terms of high interest rates and so on, which we actually think will have a positive impact. And I'll get to that in a minute. So I think if you look at Singapore, it has generally been a fairly boring market for the past decade or so. It's mostly been dominated by old world value stocks, and while the world has been chasing growth, and we think that these characteristics will be what will make the Singapore market interesting this time around. And I think, especially given the fact that there is an interest now more towards the value stocks. And we see 3 Rs that will drive this: rising rates, reopening, and restructuring. So this kind of dovetails with what Hagbin talked about in terms of tightening. If you actually look at Singapore and some of the key higher weighted segments in the market, financials, industrials, consumer, they actually do well during times of higher interest rates. The overall market gearing levels are also low. So I think the negative impact from higher rates will generally be fairly contained. And apart from that, we also have high vaccination rates here. So I think Singapore will be one of the first COVID endemic countries regionally. So I think that will also help the reopening plays. And we've also seen a fairly large pickup in terms of deal volumes that has been happening across the market. So I think, and the government also has been aggressively encouraging restructuring of a lot of the GLCs, as well as the overall business structure within the market itself to be far more relevant from a regional point of view, as well as to be more relevant from a new economy, sustainability angle as well. So I think you'll probably see a lot more deals coming through that will drive higher market weightings for Singapore as well. So I think taking the budget as well as how we are looking at the market for 2022, we like sectors such as the financials, consumer, industrials, transport, as well as some of the tech names.
All right, thanks, Thilan. Let's move on to property sectors for Thailand, Philippines, and Malaysia. Let's start with Thailand. Vanida, what are the feedbacks and indications from the developers themselves, as well as from the property industry experts over there on Thai property market outlook this year?
Good morning. For Thai property sector, firstly, I refer to our view written in the year ahead report issued before New Year. We are optimistic on the sector's outlook this year. Several developers and industry experts indicate some similar trend for this year. Number one, a significant increase in new launches as inventory has already fallen to a record low. Number two, healthy sentiment since fourth quarter of last year, after relaxation of the LTV rule to 100%. Number three, focus is on mid to high-end landed properties. And number four, more affordable condominiums targeting at local buyers. We expect a sector to post double-digit growth in all major indicators like pre-sale, new launches, revenue, and earnings. Coming to January, developers gradually released their business plans. Sansiri, one of well-known developers in Thailand, plans to increase the number and value of new projects to 50 billion, 6 times higher than only 8 billion last year. Siri will continue to focus on launching landed property projects, while new condominiums will be for affordable segment. Pre-sale and transfer target is set at around 35 billion. This is quite good indicator. We also did preview with Land and House, LH, and Quality House, QH, which are in our buy list on their business plan. Both are also upbeat on this year outlook. LH plan to raise the value of new launches by 50% year on year to around 30 billion. Also, it targets this year pre-sale at 31 billion above the pre-COVID-19 level. And for Quality House, associate of Land and House, also target to almost triple the value of new launches this year. Hence, its pre-sale should rebound sharply compared to the past 2 years. For industry expert view, new supply to come out this year may double year on year, mainly landed property. However, since they will be developed in phases, new supply are manageable and will not lead to an oversupply. Note that new supply had already declined 3 years in a row at an average 25% per annum. Mid to low-end landed property remain in focus. Positive signs include a pickup in GDP to around 4% this year, low interest rate environment, and Bank of Thailand's 100% LTV rule. Risks, on the other hand, are Omicron variant outbreak, rising of construction materials, weak purchasing power, strict lending measure from bank and financial institutions. 3 property associations are also proposing the government for more reduction in property-related fees to cover higher home price from the current 3 million baht per unit ceiling. For this year peak, we like LH target price 10.3 and QH target price 2.56 as strong earning recovery reopening place driven by core property business and hospitality service associates. We forecast earning this year of LH and QH to grow by over 20% year on year. LH and QH also have been laggards and their share price has yet to rebound to pre-COVID level. Therefore, we see a possibility of a re-rating. I stop here.
Thanks, Vanida. Let's move on to Philippines property. Miguel, your positive call on Philippines property sector is in large part relates to economic reopening. And your research note highlighted high correlations between mobility indices and property share prices. So can I highlight the key conclusions from the study and how it ties with your stock picks?
Yeah, good morning, everyone. So we correlated the property share prices with mobility data from Apple and Google. And what we saw were relatively strong correlations between the share prices and mobility data. If we take a look at the property sector, the correlation coefficient with, if you take the 7-day moving average of the property sector share prices and the 7-day moving average of the Apple Transit data, that's about a 0.7 correlation coefficient. So with the uncertainty surrounding Omicron, I think our study shows the viability of using mobility data as a leading indicator for share price movements. And what we saw was that the highest correlations were from transit data from Apple, and that's consistent with the capacity limits placed on public transport here. One key thing that we found was that the correlations of names with higher share of development revenues, for example, Ayala Land, were much lower relative to those relative to names with a higher share of leasing revenues. Leasing revenues, of course, are more dependent on the reopening of malls and retail facilities. And on that note, that's consistent with our year ahead 2022 view. Our year ahead 2022 view was go for the developers. We like names which have a development skew because we think it will be more resilient to another wave of lockdowns, another surge in infections, which is what's currently going on here in the Philippines. And I think our study points to that. So development heavy names will likely be more resilient. And I think that it's broadly supportive of our year ahead 2022 view. We maintain our positive view on the sector, and Ayala Land is still our top pick.
Miguel, I mean, Vanida earlier mentioned about, potential further relaxation on property sector measures. What about Philippines? Are there any expectations on that?
Right, not so much. I think if we look at it from the one of the the central bank, the debt to the loan to value ratio threshold is still 70%. And if as far as foreign ownership, there's been a wide scale relaxation of foreign ownership rules over the last year due to policy changes, but it's mostly in other sectors like power, telecommunications, but property so far it's still no major changes. So we don't see any major relaxations as far from a policy standpoint.
Thanks, Miguel. Wissam, like Philippines, Malaysian economy has been progressively reopened, but you maintain neutral call on Malaysia's property sector. So why are you still somewhat cautious?
Hi, morning. We maintain our neutral stand on the sector as we see risks along the recovery route. Firstly, potential interest rate hike from fourth quarter this year onwards that will make home buying less affordable. Secondly, political uncertainty ahead of GE15 could affect the purchase of big ticket items. Our studies on the last 4 general elections revealed that property sales tend to slow down 3 months before the actual election and rebound after election. This pattern happened in GE12, 13, and 14. Thirdly, no HOC this year. To some extent, HOC did help to boost the buying sentiment between 2019 and 2021. But we are not overly negative on this, as we think that this could be a blessing in disguise for large developers that have strong marketing team, and hence without HOC it should help to reduce competition with small scale developers. And lastly, margin may be hit by higher raw material costs and additional stamp duties for property price above 500,000 per unit after the end of HOC, if developers decided to absorb this additional cost. Hence, we maintain our neutral stand on the sector.
Thanks, Wissam. Let's move to Thai banks. Jesada, you remain upbeat about Thai banks. I mean, granted that banks will naturally and typically benefit from economic reopening and recovery, but are there other factors unique to Thai banks, and what are also the risks that investors should be mindful of?
Hi, good morning. As the Thai economy rely on the tourism sector, so we believe that the reopening of the economy and the rising vaccination rate should increase the consumer confidence. And we see other two factors that we need to Thai banks. The first one is the strong capital market activity that should support the bank fee income growth. And the second one is the restructure of the SCB bank that will unlock the values of the subsidiary and provide a platform to capture the growth opportunity in the high ROE and digital business. And we believe that there is the potential that other banks to follow the SCB. And for the key risks, we see the virus mutation that could reduce the consumer confidence and lead to the lower economic activities.
What's your stock picks for Thai banks?
Okay, for top pick now is K-Bank and KKP. For K-Bank is and KKP we like is for the beneficiary of the economic recovery, and valuation also attractive at this level.
Yeah, thanks, Jesada. Let's move to Ting on plantation. I think Ting year to date CPO ASP is now I think over 5,000 ringgit a ton. I think the house full year forecast is an average of 3,200 ringgit per ton. So it looks like you are looking at price to correct from where it is now. So what exactly are the story here as far as the plantation sector and CPO ASP are concerned?
Yeah, hi, morning, Suhaimi. So the near-term outlook for CPO price remains positive due to the low carry forward stocks from last year. So last week, MPOB's December stockpile of 1.58 million ton was a positive surprise as it came lower than the street estimate of 1.7 million tons, and this is the second lowest for the month of December in 15 years. For overall, for 2021, what drove prices to current elevated levels was a supply crunch. 2021's palm oil output was 5% lower compared to a year ago at about 18.1 million ton. This was a sharp contrast to an initial expectation of a strong production recovery. Now, the poor output in last year was due to unfavorable weather, lack of fertilizing activities in 2018-2019, due to low CPO prices back then, shortages of workers, and disrupted operations due to COVID-19 infections at selected estates or mills. For 2022, CPO price is off to a good start due to the weather risks in this oil palm planting region, as well as the oilseed planting regions in South America. Now, for palm oil, first half 2022 supply is expected to remain tight as we are now entering into the low production cycle, while the expectation is for a recovery in palm oil supply to happen in second half of 2022, and therefore a correction in terms of prices. That hypothesis remains fraught with challenges due to the current high fertilizer prices, disrupted fertilizer supplies, and as well as the labor shortage in Malaysia at present may possibly cause palm oil use to come in again below expectation in 2022.
Are there anything to share or update in terms of, for example, the official MPOB views and industry experts forecasts with regards to, key CPO trends on price, on output and exports?
Yeah, so according to the Director General of MPOB at last week's industry conference, he expects, or the MPOB expects, the average price for CPO to be 3,800 ringgit per ton in 2022, down from 4,400 ringgit in 2021. The message is that the current high prices are not sustainable on production recovery. MPOB forecasts Malaysia's output to grow by about 4.9% this year to 19 million tons, exports to recover by about 9% to 17 million. And by the end of this year, stockpile would grow 23% higher at 1.95 million tons. Another speaker from LMC last week as well says that the CPO price will likely ease over the next 6 months, but remain above 4,700 ringgit per ton in the first half of 2022, as supplies constraints that have pushed prices to record highs are set to persist. So the sector is looking positive thus far in 2022. Our top buys remain with KLK, Master Plant, and Sarah Oil Palms.
Thanks, Ting, and thank you everyone. Have a good week ahead. Bye-bye.
That's all for today's briefing. Have a good trading week. For specific advice, speak to your trading rep and download our reports on market insights on the Maybank Trade app or contact our sales desk. And if you wish to continue to get more updates, follow us on Spotify and Apple Podcasts. I'm Noelle Lim on ASEAN Speaks, Maybank IBG.